Welcome to the deep dive. So if you've ever glanced at the crypto world, it feels, well, less like investing sometimes and more like extreme sports, right?
Absolutely. The volatility is legendary.
Yeah, I mean, Bitcoin can swing 10% in a single day. It's chaotic, sure, maybe exhilarating, but definitely not stable.
Not by any traditional definition, no.
So how does anything genuinely stable come out of that?
Well,
That's where we get to today's topic. Stablecoins, the unlikely hero, maybe.
could be. Think of them as a sort of digital dollar.
A bridge to stability in that crypto universe. That's what we're exploring.
It's a really fascinating evolution, actually, moving from pure speculation towards something more foundational for finance's future.
I completely agree. And today we're doing a deep dive specifically into stablecoins and one company making colossal waves, Circle. You'll see it trading under CRCL.
The company behind USDC.
Yeah.
And yeah, that IPO in 2025 was, well, it got a lot of attention.
It really did. So this deep dive, it's based on a whole stack of articles, research, market analyses, Circle's business reports, investment breakdowns, the works.
We've got plenty to dig into.
Right. Our mission today is basically this. Unpack what stablecoins actually are, figure out why they're becoming so crucial now, and then look at Circle, CRCL, and ask, is this a truly groundbreaking investment or maybe a super risky bet?
So by the end, you should feel, hopefully, pretty well informed on where things stand.
Exactly. So let's start at the beginning. What are stablecoins?
Okay, so stablecoins are fundamentally a special kind of cryptocurrency. Their main design goal, their whole reason for being, is to minimize price swings.
Okay, minimize volatility. How?
Well, they try to anchor their value to something stable. Usually that's a fiat currency like the US dollar, but it could theoretically be gold or, a basket of assets.
So there's like a stable value anchor in this often stormy digital sea.
That's a good way to put it. They act as a crucial bridge, really, between traditional finance or TradFi and the crypto world.
And people are using them for a lot of different things.
Oh, yeah, a whole range. Payments, settlements, just storing value, cross-border transfers. It's broad.
And the key thing is they solve that massive crypto volatility problem, right? Making digital assets actually practical for daily stuff, unlike Bitcoin where the price is all over the place.
Exactly. They can be a kind of safe haven when the market tanks. You park your funds there without totally exiting the crypto ecosystem.
Right. And they make trading faster, cheaper.
On crypto exchanges, yeah. You bypass traditional banking systems, the delays, the fees, and maybe most importantly, they're pretty much the bedrock of DeFi, decentralized finance.
The foundation.
Absolutely. DeFi, as we know it, wouldn't really work without stablecoins providing that stable medium of exchange and unit of account.
Okay, so there are different kinds, right? Not all stablecoins are built the same.
Correct. There are three main types we should probably break down.
Let's do it. What's the first one?
The first, and probably the most common, the most mainstream, are fiat collateralized stablecoins.
Okay, fiat collateralized. How do they work?
These are the most straightforward. Think of it like a digital IOU. For every one stablecoin they issue, the company, the issuer, holds $1 or something equivalent, like short-term U.S. Treasury bonds in reserve.
So a strict one-to-one peg, backed by real assets.
That's the design. The big examples here are USDT, which is Tether, and USDC, which is Circle's coin.
Right, and these are the dominant ones.
By far. They hold something like 85% of the market combined, mostly because they're liquid, relatively compliant.
But that trust factor is huge, right?
Yeah.
You have to believe they actually have the reserves.
Absolutely critical. Their credibility totally depends on the issuer being transparent and getting regular, verifiable audits of those reserves. Without that, the whole thing falls apart.
Okay, makes sense. What's the second type?
Second, we have crypto-collateralized stablecoins.
Backed by other crypto. That sounds kind of risky. Given crypto's volatility, how do they stay stable?
That's the million-dollar question, isn't it? Yes, they are backed by other cryptocurrencies, but the key is they are usually over-collateralized.
Over-collateralized, meaning?
Meaning you have to lock up more value in crypto collateral than the value of the stablecoin you want to mint. So, for example, you might need to pledge, say, $200 worth of Ethereum to get $100 worth of the stablecoin.
Ah, so there's a buffer. A cushion against price drops in the collateral.
Exactly. It provides a safety net. DAI is probably the most well-known example here.
But still riskier than fiat-backed.
Inherently, yes.
Yeah.
Because the collateral itself is volatile. They can offer things like leverage, maybe yield opportunities, but the risk profile is definitely higher.
Got it. And the third type, the one that makes people nervous.
Right, that would be algorithmic stablecoins.
Okay, algorithm-based.
Yeah.
So no collateral.
Not in the traditional sense, no. These try to maintain their peg, usually to the dollar, purely through software. Complex algorithms and smart contracts automatically adjust the supply of the stablecoin to keep the price stable.
Sounds complex.
Uh,
And maybe fragile.
Extremely fragile, as we saw. It's a fascinating idea in theory, but the catastrophic collapse of Terra USD, or UST,
Yeah, that wiped out billions.
billions, it was a brutal lesson. If the algorithm breaks under pressure, the whole system can just spiral into oblivion very, very quickly. So, understandably, market interest in pure algorithmic stablecoins has dropped off significantly since then.
Okay, no kidding. So those are the types. Let's zoom out now. The market itself, you said the scale is huge.
It's staggering, really. As of 2025, the global stablecoin market cap is north of $210 billion. Some estimates go as high as $251 billion.
Yeah, that's serious money.
But the market cap is only part of the story. Look at the transaction volume. We're talking an annual transfer volume of around $35 trillion.
Trillion.
Trillion with a T. And monthly on-chain transaction volume is over $4 trillion.
Okay, put that in perspective for us.
That monthly volume, it's far more than Visa and MasterCard combined.
Get out. Seriously.
Seriously, stablecoins are processing a massive amount of value.
That's genuinely mind-blowing. It's not just some niche crypto thing anymore.
Not at all. And the user base is growing too. Over 30 million active addresses, plus increasing institutional adoption. It's becoming mainstream plumbing.
And within that huge market, you mentioned the dominant duo.
Right. USDT, Tether, and USDC Circle. Together, they control about 90% of the market.
What's the breakdown?
USDT is the leader, around 60% market share. Market cap roughly $153 to $155 billion. USDC is second, about 25% share, with a market cap around $60 to $61 billion.
Okay, so what's driving all this incredible growth? What are the engines behind this boom?
Several key drivers. First, a massive one is cross-border payments.
Making international money transfers better.
Dramatically better. Think about transaction costs dropping to fractions of a cent, like 0.0002 pounds, and settlement times. Instead of waiting 2-3 days for a traditional wire transfer, it happens in minutes on the blockchain. That's like over 1,000 times more efficient. It's a revolution for remittances, global payroll, B2B payments.
Stripping out friction and cost.
Exactly. Then there's the DeFi ecosystem. As we said, stablecoins are the lifeblood there.
The essential trading pair, the lending collateral.
All of it. DeFi's locked-up value is huge, around $240 billion, and growing incredibly fast, over 150% compound annual growth rate. Stablecoins fuel that.
Okay. What else?
They're also becoming alternative currencies in some parts of the world.
You mean places with high inflation?
Precisely. In countries battling currency instability, think Argentina, Turkey, stablecoins, especially dollar-pegged ones, are a popular way to kind of dollarize your savings. It lets people bypass local financial system limits and protect themselves from their currency losing value.
That makes sense. A way to hold dollars digitally when maybe you can't easily access physical dollars or stable banking.
Exactly. And another really interesting area is real-world asset tokenization, or RWA.
Tokenizing things like bonds, real estate.
Yeah, or even more niche things like infrastructure assets, charging stations, energy storage, putting them on the blockchain.
And stablecoins are needed to trade these tokenized assets.
They're the perfect medium. They provide the transaction layer, the liquidity to make these tokenized RWAs actually tradable, instantly settled. It connects the digital and physical asset worlds in a powerful way.
Okay, this is all fascinating, but there's a huge piece we need to talk about. Regulation. Compliance. This feels like a major turning point.
It absolutely is. It's maybe the biggest catalyst right now. Major economies, the US, UK, Hong Kong, are all moving fast to create clear rules for stablecoins. Compliance is becoming the new frontier.
Let's start with the US. There was big news recently, right? The Genius Act.
That's right, the Global Economic Normalization and Innovation in U.S. Stablecoin Act, passed in May 2025, expected to become a law by summer.
And what does it do? What's the impact?
It's huge. Crucially, it mandates 100% reserve backing for stablecoins, specifically with U.S. dollars or highly liquid assets like short-term treasuries.
So codifying that 1.1 backing we talked about.
Exactly. Plus, compulsory annual audits, strict anti-money laundering rules. It aims to make stablecoins safer, more transparent.
And there's a strategic angle too, right? About the dollar.
Definitely. Part of the goal is to ensure the U.S. dollar remains dominant in the digital age. The act also restricts big tech companies like Meta or Amazon from issuing their own stablecoins. Keeps it within the financial regulatory perimeter, essentially.
Interesting. Okay, what about Hong Kong? They've been proactive too.
Very proactive. Their stablecoin ordinance went into effect August 1st, 2025. And this is significant because it's actually the world's first dedicated law specifically for fiat-backed
The
stablecoin.
first. Wow.
Yeah, it requires issuers to get a license from the Hong Kong Monetary Authority, follow strict rules on reserve management, redemptions, setting a clear standard.
And the UK.
UK's FCA, their financial regulator, also has proposals out, similar goals, ensuring stablecoins maintain their value, requiring transparency about reserves. It provides another clear path for companies wanting to operate compliantly.
So taken together, all this regulation, it's actually a good thing for the legitimate players.
Absolutely. It boosts transparency, builds investor confidence, especially institutional confidence, and basically accelerates stablecoins' acceptance into the traditional financial system. It sorts the wheat from the chaff.
It's like crypto's finally getting its grown-up rules.
In a way, yes. At least for this corner of it.
Which leads us perfectly to Circle,
Yeah.
CRCL, the company behind USDC, the second biggest stablecoin. We mentioned their IPO. Tell us more about Circle itself.
Okay, Circle. Founded way back in 2013, based in Boston, they issue USDC, and yes, the big milestone is being the first fintech focused squarely on stablecoins to go public on the New York Stock Exchange. That's CRCL.
And USDC is big, you said.
Yeah, as of March 2025, circulation was around $60.1 billion. They claim over 600 million users, 4.9 million active wallets. It's a substantial operation.
So what makes them stand out? What are their core advantages in this market, especially now with regulation coming in?
Well, their biggest advantage, and they've leaned into this heavily, is compliance and transparency.
They've always aimed for that.
Yeah.
Compared to Tether, maybe.
Exactly. They have licenses like FinCEN in the US, EMI in the EU. Crucially, they state USDC reserves are 100% backed by cash and short-term US treasuries.
Managed by a big name.
Yes, managed by BlackRock, held at institutions like Bank of New York Mellon. And they get regular independent audits. Grant Thornton does them, for example. Their structure seems designed to meet the requirements of things like the Genius Act, that high-quality liquid assets rule.
So that regulatory push we talked about potentially plays right into their hands.
It's a huge part of the bull case for Circle. Their transparency is a stark contrast to Tether, which has faced years of questions about its reserves.
Okay, so compliance is number one. What else?
Their global network is pretty expansive. They've built deep partnerships with major players, Coinbase, Stripe, Visa.
Plumbing again?
Kind of, yeah. It creates this global clearing network, positioning USDC as this sort of on-chain dollar settlement layer.
And how do they actually make money? If it's one-to-one backing, where's the profit?
Good question. Their revenue model is primarily based on the interest earned from those reserve assets.
Ah, so they hold billions in treasuries and they collect the interest.
Exactly. Those reserves are invested in low-risk, interest-bearing assets, mainly U.S. Treasury bonds. That's the bulk of their income. They also get some transaction fees from their platforms.
And are the numbers good? Is it profitable?
The revenue growth is strong. They reported $579 million in revenue for Q1 2025. That's up almost 60% year over year. For all of 2024, it was $1.676 billion. So yeah, strong growth, stable cash flow from that interest.
But there's a catch with that interest income, right? Something about Coinbase.
There is. About 99% of their revenue comes from that interest, but they have a deal where they share 50% of it with Coinbase.
50%, that's a lot.
It is. It brings their gross margin down to around 39%. It reflects the importance of that Coinbase partnership for distribution, but it's a significant chunk of revenue going out the door.
Okay. So compliance, network, revenue model. We touched on policy tailwinds, regulation helping them. What about tech?
They're strong on technology and innovation, too. USDC isn't just on one blockchain. They support multi-chain deployment. Solana is a big one. They're pushing developer services, trying to expand the use cases.
Oh, grammable money.
That's the idea. Smart contracts enabling things like automatic payments, conditional settlements, stuff you can't easily do with traditional money.
And they're working with big traditional players, too.
Yeah, their strategic ecosystem collaboration is key. Working with Visa, PayPal using USDC for cross-border settlement, even JP Morgan exploring USDC as collateral. That signals growing mainstream acceptance.
Shopify payments, too, you mentioned.
Right, integrated with Shopify, allowing USDC payments in, like 34 countries, making it easier for actual businesses to use.
Okay, so that paints a picture of the company. Now, the million-dollar question, or maybe the $40 billion question, given their market cap, is CRCL a smart investment? Let's get into the opportunities versus the risks, the dark reefs.
Absolutely. Let's start with that stock performance because it was, well, phenomenal right after the IPO.
Yeah, refresh our memory. IPO June 5th, 2025, priced at $31.
Right. Raised $1.1 billion, and it was 25 times oversubscribed. Huge demand.
And then it just took off.
Exploded. Jumped 168% on day one, closed over $83, hit $103 intraday, market cap shot past $32 billion immediately.
Wow. And it didn't stop there.
Kept going, a mad surge as some called it. Ran up to $150, even touched $240 within about 2 weeks.
2 weeks. That's nearly an 800% gain from the IPO price.
Pretty much briefly pushed the market cap over $40 billion, easily one of the strongest IPOs of 2025.
And Wall Street seemed keen. Institutions liked it.
Yeah, buy ratings came out, like from Seaport Global, targeting $235. ARK Invest talked about buying up to $150 million worth. Lots of institutional confidence baked in early.
Okay, so what's the core investment logic here? Why were investors and why are they still so bullish on CRCL?
Several key points. First is industry leader scarcity.
Meaning they're one of the few pure plays.
Exactly. Second biggest stablecoin issuer. First public company really focused on this. That gives it a scarcity premium. There aren't many ways to get direct public exposure to this space.
Okay, and the regulation angle again, the compliance dividend.
Right. The thinking is, as regulations tighten, less compliant players, maybe like Tether, could face pressure or lose share. That could allow USDC to potentially grab much more market share, maybe even double it from 25%, attracting all that safety-conscious institutional money.
Makes sense. And the overall market growth.
That's a huge part of it. Explosive growth potential, remember those projections? The stablecoin market going from $250 billion now to maybe $2 trillion by 2028.
Massive waste to ride.
If Circle just maintains its share, let alone grows it, the potential is enormous. Analysts estimate Circle's revenue could grow 25–30% annually.
Plus their business model is seen as pretty stable, right? Based on treasury interest.
Relatively stable, yeah. It provides strong cash flow, maybe more resilient to crypto market crashes than other crypto businesses. It's tied more to interest rates.
And there's that idea of it being an extension of dollar hegemony.
Yeah, USDC is seen as furthering U.S. influence in the digital asset world. Aligning with U.S. strategic interests could mean ongoing policy support, or at least less regulatory hostility.
Then finally, just strong institutional backing. Goldman Sachs, JP Morgan, BlackRock involved. That adds credibility.
Definitely. Having those names associated, plus the big banks underwriting the IPO, it lends a lot of weight.
Okay, that's a compelling bull case. But every investment has risks. Let's talk about those dark reefs. What could go wrong?
Plenty. First, even with clearer laws, regulatory uncertainty isn't gone. Future rules could change. Maybe higher capital requirements get imposed, increasing Circle's costs. The landscape is still evolving.
Okay, what about competition?
Intensified competition is a big one. Let's not forget, Tether, USDT, is still bigger, market share-wise 61% versus USDC's 27%.
Right, they haven't disappeared.
Not at all. And now you have traditional finance giants entering the ring. JP Morgan has its own projects, PayPal has PYUSD.
So competition from TradFi, not just other crypto players.
Yes. And then there are these innovative, maybe riskier, high-yield stablecoins popping up, like USDE offering crazy yields like 40% APY.
40% APY. How is that even possible? That sounds incredibly risky.
It almost certainly is incredibly risky. It likely involves complex DeFi strategies, leverage, things that can blow up spectacularly. It's probably unsustainable and carries immense hidden risks. But the lure of that yield could pull some funds away from safer options like USDC, at least on the margins.
Okay, so competition from multiple angles. What else?
A huge one is interest rate sensitivity. Circle's revenue is heavily tied to interest rates on U.S. Treasuries.
Because that's where their profit comes from.
Right. So if the Federal Reserve starts cutting rates, say a 1% cut, that could slash Circle's annual revenue by over $400 million. That's like 20% of their total revenue gone. Huge impact on profit margins.
So their fate is somewhat tied to Fed policy. That's a big external factor.
Absolutely. Then there are valuation concerns. We talked about the surge. Is it a bubble?
That price to earnings ratio seems sky high.
Astronomical. Between 221x and over 400x at points. That implies the market expects perfection, incredible growth for years.
What kind of growth is needed to justify that?
You'd need something like a 60% compound annual growth rate for the next 3 years just to grow into that valuation. That's a very high bar. If growth disappoints, the stock could see a major correction.
And comparing its market cap to assets under management.
Yeah, its $40 billion market cap is about 65% of its $61 billion USDC in circulation, which is like its AUM. That ratio is much, much higher than traditional asset managers who grow much slower. It signals a lot of future growth is already priced in, maybe too much speculative fervor after the IPO. Volatility and pullbacks are likely.
Okay, what about the stablecoin itself? The risk of depegging.
Still a risk, always a risk. USDC has proven pretty resilient. It briefly dipped below $1 during the Silicon Valley Bank crisis, but recovered quickly. But no stablecoin is 100% immune. Extreme market panic, another major bank failure. Temporary depegging is always possible.
And counterparty risk. Trusting Circle and its partners.
Yep. Holding USDC means you're trusting Circle, BNY Mellon, BlackRock to manage those reserves properly and securely. The risk seems low, given the players involved, but it's not zero.
What about just holding dollars? Inflation risk.
That too. Holding USDC is economically similar to holding US dollar cash. So over the long term, inflation will erode its purchasing power just like cash.
And one last thing, that Coinbase revenue share.
Right, the partnership revenue sharing. It's significant. We saw numbers fluctuating between $248 million and $908 million paid to Coinbase from 2022 to 2024. That variability impacts Circle's cost structure and predictability. It's a key relationship, but an expensive one.
Okay, wow. A lot to weigh there. The potential is huge, but the risks are very real. So how should someone listening approach this? What are some tailored strategies?
It really depends on your risk tolerance. For a more aggressive investor, someone really buying into the long-term vision.
The digital financial infrastructure play.
Right. They might consider buying on dips. They'd need to watch USDC market share changes very closely, look for new business lines opening up, and definitely monitor those policy catalysts. The final Genius Act vote, the Hong Kong licenses in August, these could be major inflection points.
Okay. And for someone more conservative or prudent, someone wary of that high valuation and volatility.
For them, patience is probably key. Maybe wait for the IPO lockup period to expire. That's usually 180 days, when insiders can start selling, which can put pressure on the price.
Let some of the initial hype cool down.
Exactly. Or wait for more financial data like the Q3 earnings report to get a clearer picture beyond the IPO prospectus. Also, wait for more clarity on the Fed's interest rate plans. And watch that USDC reserve growth. Is it consistently growing fast, like over 30% quarterly? That kind of growth is needed to support the valuation.
Makes sense. And regardless of approach, risk management is crucial.
Non-negotiable in this space.
Yeah.
First rule, control your position size. Don't bet the farm. Maybe 5–10% of your portfolio, max, in a single high-growth stock like this.
Diversification.
Always. And constantly track the key variables. Global regulations, interest rates, what Tether and the banks are doing, the macroeconomy. Things change fast.
Use stop losses maybe? Take profit targets.
Absolutely. Have a plan for getting out, either to lock in gains or cut losses if things go south. Don't just buy and hope.
Okay. So as we wrap up this deep dive, let's leave our listeners with that provocative thought. We're seeing stablecoins shift from just being trading tools
to becoming the actual on-chain veins of a new financial system. Goldman Sachs thinks they could handle 15% of global payment flows in just 3 years.
15%. That's massive.
It leads to that big question. Is Circle's huge valuation today really just buying an option on the future dominance of programmable money? Are we paying now for what it might become?
Yeah, like when that iPhone moment hits for payments, completely reshaping how money moves. Could Circle be the Apple of this new digital currency era?
That's the multi-trillion-dollar question, isn't it? And the answer probably lies in that triple symphony you mentioned.
Fed rates, the final Genius Act details, and the speed of USDC moving on chain.
Exactly. Investors really need to buckle up. This financial revolution highway, it looks golden, but there are deep cliffs hidden along the way.
So, care for consideration, assess your own risk tolerance, do your own homework. And remember, CRCL is the company's stock, not the USDC stablecoin itself. Important distinction.
Very important. Don't confuse the two.
Well, this has been incredibly insightful. Thanks for breaking it all down.
My pleasure. It's a fascinating space to watch.
Absolutely. Thanks, everyone, for joining us on The Deep Dive. We'll catch you next time.